Okay, today we're going to talk about Chapter 5, which is Cash and Receivables. So Chapter 5 starts on page 202 of your textbook. So in previous chapters, we went over some overall concepts of financial statements and accounting standards, as well as an overview of financial statement elements. So going forward, the chapters are going to focus on specific financial statement elements and the different measurement and disclosures and requirements for each of those elements. So as I've mentioned before, this course focuses on assets. Later courses focus on liabilities and equity stuff. So this chapter is focused on cash and receivables. You should follow along in your textbook, and if there's something that you think you need to read again or read in more detail, you can pause the recording and do that, and then start up the recording again. So the learning objectives for this chapter, the first is apply the standards and procedures for recording, reconciling, and reporting cash and cash equivalents. Number 2 is explain the need for internal controls for cash, specifically cash, and other assets more generally, and evaluate the adequacy of cash controls in different situations. Number 3 is to apply the standards and procedures for the initial recognition, subsequent measurement at the balance sheet date, and derecognition of trade receivables. And number 4 is to apply the standards to account for non-trade receivables. So cash and cash equivalents. Cash is the universally accepted medium of exchange. So it's important to understand what cash includes and excludes because it's not necessarily just straight cash. So inclusions in cash and cash equivalents. So cash is pretty self-explanatory. It's bills and coins and demand deposits. Cash transactions include transactions completed by writing or receiving checks, bank drafts, and electronic wire transfers. Cash equivalents are short-term, highly liquid investments that are readily convertible to known amounts of cash and that are subject to insignificant risks of changes in value. So this often includes things like guaranteed investment certificates that mature within 3 months, savings accounts held with banks, checking accounts held with banks, etc. Cash balances can be negative, so an bank overdraft can be considered cash in certain situations. So what's excluded from cash and cash equivalents? Funds subject to restrictions or appropriated are excluded. So cash that is appropriated for a sinking fund would be in non-current assets since such funds are not available for other uses. Financial investments subject to significant fluctuations in value are excluded. So share prices of investments in shares traded on a public exchange can change dramatically on a daily basis. So those types of investments are not considered cash equivalents. So as we discussed previously, the criteria for cash equivalents is number 1, it's readily convertible into cash, and number 2, there's insignificant risk of change in value. So if you hold shares in a company that's traded on the stock market, you could sell your shares at any point in time and turn them into cash. So it does satisfy that first criteria. But since the value of those shares fluctuates so regularly, it would actually be exposed to significant changes in value. So it doesn't meet that second criteria. So it couldn't be considered a cash equivalent. Cash held in foreign currencies. So we make the generalization that foreign currencies are readily convertible to Canadian currency. There could be a few exceptions, but for the purpose of the textbook and this class, this assumption can be made. Foreign currencies have low risk of value changes. Again, that's a generalization made for the purposes of this textbook and our class. In actual practice, if you held currencies from volatile economies, then you'd have to use professional judgment in order to determine if the risk of the value changes in that currency is low or not. So professional judgment is required. So negative balances is an overdraft. So when you've drawn more out of your bank account than actual cash was in there. So it's not listed as a liability unless the net balance is negative. So for example, if you have one bank account with a positive balance of $100,000 and you have another bank account that has an overdraft, so a negative balance of $25,000, then on your balance sheet, you would show the net $75,000 positive balance as an asset, so as cash. But if the negative bank account had a balance of $150,000, then the overall net total of those two bank accounts would be negative $50,000. So it would be shown as a liability. And when it's shown as a liability, it's called bank indebtedness. So you would report that as a deduction from cash and cash equivalents. So implication for the cash flow statement. So cash and cash equivalents, we went over previously. Exchanges of cash and cash equivalents for items that are not cash or cash equivalents result in cash flows. So we looked at this when we went over the cash flow statement in chapter 3. Changing the composition of cash and cash equivalents is not a cash flow, it's just a shift within cash and cash equivalents. So an example of this would be if you buy a 3-month GIC and you pay cash for it, it doesn't actually change the balance of cash and cash equivalents since they're both included in that balance. It would just change the composition of how much of that balance is cash and how much of it is cash equivalents. So bank reconciliations. Bank reconciliations tie together the amount of cash per the records, so the general ledger or the books, and the amount of cash per the bank, so what's in the actual bank account. So what are the reasons for preparing a bank reconciliation? To understand why the two sets of records differ, to identify any bookkeeping errors, and to contribute to the overall internal control over cash. So for example, say that you write a check to a vendor to pay for an invoice. When you write that check, you would debit accounts payable to clear out the accounts payable amount, and then you would credit cash to reflect that your cash is going down since you're paying someone. However, the bank account wouldn't actually show that decrease in cash until the vendor actually cashes their check. So until the vendor cashes that check, there will be a difference between the cash balance on the books, so in the general ledger, and the cash balance in the bank account. So there are 2 steps to reconcile bank balances, and these are stated on page 206 in your textbook. So the first step is to begin with the bank balance per the bank statement, and then adjust for any reconciling items to come up with the corrected cash balance. And the second step is to start with the company's book balance or general ledger balance and adjust for any reconciling items that aren't picked up but that have gone through the bank to get to the corrected cash balance. And bank reconciliations should be done periodically. Typically, they're done every month at month end. So Exhibit 5-2 on page 207 shows an example of the different steps for a bank reconciliation. So the information used for this bank reconciliation is stated on page 207. So in this case, step 1 would be to start with the balance per the bank statement. So on page 207, it tells you that the bank statement shows a balance of $5,890. Then you would need to adjust for things that have been recorded in the general ledger, but that haven't actually gone through the bank yet. So in this case, there are a couple of deposits in transit. So these are deposits that the company has made. So they've recorded in their general ledger that they've received this money, but the deposits haven't actually cleared through the bank yet. So you would need to adjust the bank balance and add those numbers in. The next thing is to subtract any outstanding checks. So this is like the example that I just went over previously, where the company has, written a check to a vendor. So they've in their books recorded that the cash balance has decreased, but those vendors haven't actually cashed those checks yet. So the bank balance isn't properly reflecting that those amounts need to be taken out. So they need to be subtracted from the bank balance. And the final item on here is a bank error for $900. So it says on page 207 that there was a bank error, that check number 3347 was written for $8,790, but when the bank processed it, they switched some numbers around and processed it for $7,890 instead. So since the actual amount of the check is $900 more than what the bank put through, we need to subtract that from the bank balance. So in this case, for step number 1, the corrected cash balance is $65,790. So then we would go to step 2, which is to take the balance per the company's books or the general ledger and subtract it for anything that's gone through the bank, but that we haven't yet put through the GL. So in this case, there was an error in the books for $100 related to a cash deposit. They had posted that incorrectly, so that amount needs to be subtracted. And then on the bank statement, there was also some bank charges, and those hadn't yet been recorded in the general ledger, so again, those need to be subtracted. So the corrected cash balance for step number 2 is $65,790, and that ties to the corrected balance that we did in step 1 as well. So those two balances should always tie to each other. So let's go through an example problem now to go over bank reconciliations. So it's problem 5-12, which is on page 233 of your textbook. So when we go through the example problems, I do recommend that you pause and work through the problems on your own first, and then press play and follow along to see if you got the problem correct. It's just a much better way for you to learn the concepts and to test what you know, rather than just watching me do it for you, which isn't going to be very helpful. So problem 5-12 on page 233. So Chris Hacker Limited is about to reconcile its bank statement for the month of September 2018. The pertinent information is as follows. So the bank statement balance is $6,627.87. The GL balance is $5,685.45. The bank erroneously deducted another company's $800 check from CHL's bank account. CHL issued 3 checks in September that are still outstanding at the end of the month. CHL received notification that a check for $245 that they deposited to their account was returned as NSF, so non-sufficient funds, and the bank charged CHL $28 for that NSF check. And the last thing is that the bank statement includes a $14 service charge for the month. So let's work through this problem. So if we're following the steps in the example on page 206 to 208 of your textbook, then we would start first with step number 1. which is to begin with the bank balance and then adjust for items that are transactions recorded in the general ledger, but the bank hasn't yet recorded. So the first step is to start with the bank balance. So in the problem, it tells you the bank balance is $6,627.87. So for whatever reason, this is actually a typo, and in the answer key, the bank balance is $6,626.87. So we're going to use that number because that's what gets us to the correct balance in the end. But normally those two numbers would tie. So bank balance of $6,626.87. The next thing that we would need to do is to add back the bank error. So it states in the question that the bank deducted some other company's check from CHL's bank account in error. So we would need to fix the bank balance so that it's correct. So since the bank shouldn't have deducted that $800, we would need to add that back to the bank balance. The next thing we would need to do is to deduct the outstanding checks, because it stated there was a number of checks they had written during September, but that hadn't cleared the bank yet. So it was check number 222, check number 223, and check number 225. So if we list all those numbers and add that total up, we'd need to subtract those amounts from the bank balance, since we wrote those checks and we know they'll be cashed eventually. So it doesn't say anything about there being any outstanding deposits or anything, so there's nothing left that we would need to adjust for step number 1. So this would get us to our corrected bank balance at September 30th. Which is $5,398.45. Step number 2, for page 206, would be to take the company's GL balance and then adjust it for anything that was recorded in the bank that should be recorded in the books, but that hasn't been yet. So first we start with the balance per the general ledger at September 30th. And in the question, it states that balance is $5,685.45. Then we would need to adjust for the NSF check. So the NSF check is something that would have been recorded as a deposit in the general ledger, so it would have been recorded as an increase in cash. But then the check never actually cleared in the bank because it came back as non-sufficient funds. So we need to remove that cash from the GL balance now. And the amount of that check was $245. We then need to adjust for any service charges. So in this case, they got charged a $28 fee for that non-sufficient funds check. And they also had their regular monthly fee of $14. So together that's $42 of service charges that we would need to remove from the GL balance. So there was nothing else listed as something that needs to be adjusted for. So this gets us to our corrected GL balance at September 30th. And you can see that this corrected balance of $5,398.45 ties to our corrected bank balance that we did in step number 1. So this is all for A, where we prepare the cash reconciliation for this company. For required B, we need to prepare the adjusting journal entries to correct for any items that were noted in the cash reconciliation. So in this case, there was a number of items that we said weren't recorded in the GL yet, but that needed to be. So we would need to post adjusting journal entries for those. So the first would be for the NSF check. So there's a couple of ways that this could be done. depending on whether or not CHL is planning on charging the customer for that NSF check fee. So the first way would be to debit accounts receivable and credit cash for an amount of $273. So that $273 is made up of the $245 NSF check original deposit amount plus the $28 NSF charge that CHL was charged because the check didn't go through. So most companies would charge that through to the customer. So CHL would need to set up that they still owe, that customer still owes them, and they owe them a bit more now for that NSF check. And they need to credit cash for that amount because as we adjusted up here, that amount isn't actually sitting in their bank account. The other option would be if they're not going to charge that $28 through to the customer, then they would set up the accounts receivable for the original amount that it was, which it says was $245. And the NSF check charge of $28 would go to bank charge expense. And you would still credit cash for that $273 since that's what came out of our bank account. The second entry would be to record the regular monthly bank service charges. So you would need to debit bank charges expense and credit cash, and the amount of that was $14. So for Part B, you would either do this entry or this entry, and then your second entry would be for the bank charges expense. So that's P5-12. So cash management, internal controls, and fraud prevention. So there are significant risks associated with cash. A bank reconciliation is a detective control, and it should be assigned to the appropriate employee. Preventative controls or measures are equally or more important than detective ones. So a bank reconciliation is a detective control, meaning that it can detect when an error has occurred, but more importantly is having preventative controls, which prevents errors from even happening in the first place. So segregation of duties. So think about the list of activities surrounding cash. So employees make sales to customers and record credit sales and accounts receivable. Customers pay using cash or checks or credit cards. So then the employees record those payments against the customer's account. The employees combine cash, checks, and credit card receipts from different counters and then make a bank deposit. The company makes purchases on credit, and then they issue checks to pay for those accounts payable. And then the bank issues a bank statement to the company each month. So it is important to separate certain activities surrounding cash. So this would be to restrict the ability of sales staff to modify or delete accounts receivable, and any credits or refunds are recorded on a separate credit note. Assign employees with no access to the receivable records the task of recording any cash or checks received. Assign different employees the task of depositing funds to the bank. Have accounts receivable staff, separate from the above people, record payments against specific accounts. So, for example, say a company has an accounts receivable amount due to them from a customer for $100. So that customer comes in and pays the entire $100 in cash. An employee, let's call her Alice, collects the $100 payment. If Alice also has access to the receivable records and can change them, she could pretend to give the customer a discount of $25, which would reduce the receivable to only $75. but Alice still would have collected the full $100 from the customer, so Alice could then pocket the other $25. But if Alice doesn't actually have access to the receivables module, then she wouldn't be able to do that. So that's where segregation of duties is important. So segregation of duties may be the most important to reduce the risk of cash misappropriation. When duties are segregated, fraud requires collusion among 2 or more employees, which is more difficult to execute. So in that example I just went over, if Alice doesn't have access to the receivables module, then in order to commit fraud, she'd have to bring in someone who does have access, so it makes it more difficult. In smaller enterprises, segregation of duties is often difficult because there's not necessarily enough employees to be able to segregate all of the duties perfectly. So in those cases, direct supervision is important. Monitoring by staff and customer. So it's not always possible to segregate duties because of time and cost prohibits it. So for example, at a retail store, it's not really possible for one staff member to ring in the sale and then have a different staff member take the actual cash from the customer. So there's a lot of reliance on staff and customers. So the textbook uses the example of retail stores who say your purchase is free if you don't get a receipt, so that customers are ensuring they get a receipt, which would mean that employees run all purchases through the cash register. Most of the time, if you were a customer and you noticed that the employee wasn't actually ringing something through the cash register, you probably wouldn't be okay with it. Or you'll notice if you go to like Walmart or something, when the price comes up as incorrect or you need a discount, they call a separate higher up cashier who comes over to approve the discount. So it's not just done by that one regular cashier. Implications for internal controls of other areas. So cash is one of many assets subject to misappropriation. Cash is highly vulnerable to be stolen. But there's controls needed for other non-cash assets too. An experiment shows people are more willing to lie when dealing with non-cash items. So another example of a non-cash item that's subject to misappropriation could be inventory. So staff stealing items from inventory. Okay, so an overview of accounting for non-cash assets. So non-cash assets are due to accrual accounting. So for example, accounts receivable being recorded because you made a sale, but you didn't actually collect cash yet, or a prepaid expense being recorded because you did pay cash, but you haven't received that good or service yet. So questions common to all non-cash assets. Does a transaction give rise to an asset or expense? What is the appropriate balance sheet value for an asset or a class of assets? When should an asset be removed from the balance sheet? So initial recognition and measurement, asset or expense. So defining expenditure is an outflow of cash or other resources, distinguished from expense. And defining capitalize is recording an expenditure as an asset on the balance sheet. So that's when it has those 3 asset criteria that we discussed in previous chapters. So it provides a future economic benefit, it's under the entity's control, and it results from a past transaction. Defining expense is an amount reported on the income statement that reduces the amount of profit or increases the loss for the period. So as we just mentioned, the definition of an asset has 3 characteristics. It has future economic benefits that will flow to the entity. The asset has to be under the entity's control, and it results from past transactions. So asset valuation on the balance sheet. You need to determine if an asset is appropriately valued and consider if the asset is overstated, so is a write-down to current value required. Valuation adjustments increase representational faithfulness. So derecognition is removal of an asset from the balance sheet. So that's determining if an asset should be removed. For example, if you're selling inventory, you have to remove the inventory from the balance sheet when the inventory is sold. Or depreciating equipment costs over time, that slowly removes the asset from the balance sheet. So the accounting term is derecognize. So trade receivables, initial classification, recognition, and measurement. So trade receivables or accounts receivables are from ordinary sales. So that's receivables that are earned from selling things in the ordinary course of business. A receivable is a cash flow that's temporarily foregone. So you haven't collected the cash yet, but you are entitled to it. It meets the definition of an expenditure and an asset. So remember, there's a difference between expenditure and expense. The time value of money is ignored for trade receivables because it's expected that the money will be received within a reasonably short amount of time. So gross versus net method. There may be cash discount offered to customers, so there are alternatives that exist for recording accounts receivable. The gross method is to record at the face value, and the net method is to record at the sales price less the cash discount. So in this case, Exhibit 5-4, which is on page 212, shows the standard entry that's made when you make a sale on credit. So you debit accounts receivable and credit sales revenue. For the gross and net method, Exhibit 5-5, which is on page 213 to 214, goes through this. So there is some some information given on page 213 just above this exhibit that leads into these amounts in this table. So it's a sale for $1,000, and the terms are that the customer can get a 2% discount if they pay within 10 days. So the gross method would record the accounts receivable at the full amount, which is under the assumption that they won't be paying within that 10 days. And therefore the company will receive the full 1,000 because they won't have to give the customer a discount. So if the customer does pay within the 20 days, then the difference between the cash received and the accounts receivable amount is recorded as a sales discount, which is an income statement account that is a contra account against the sales account. So you can see here, they've recorded it at the full 1,000. When they actually pay within the 10 days, they only get cash of $980. So the difference between the $980 and the accounts receivable of 1,000 is recorded as a sales discount, which is an income statement account. The net method is recorded with the assumption that the client will pay quickly and get the discount. So AR is actually only recorded for the 98% because it's assumed that 2% won't be received. So in this case, if the client doesn't actually pay within 10 days, then the difference, that 2% difference, is recorded as interest revenue because it's considered to be revenue earned as a result of the client paying later. So subsequent measurement of trade receivables, so accounting for bad debts. So there is a risk of uncollectible amounts being included in receivables. So receivables should be recorded at the expected net realizable value, which means that they should be recorded at what the company thinks they are actually going to receive. So if there's amounts that won't be received, that needs to be adjusted for. So you have to adjust for both known and anticipated uncollectible amounts. That known as uncollectible, so that's the direct write-off method. So that's when you write off the receivable owed from a specific customer that you know or think won't be collected. So, like I said before, net realizable value is the value expected from the sale of an asset. And the direct write-off method is to record the expense when an accounts receivable is deemed to be uncollectible. So reasons for adjusting for uncollectible amounts, moral hazard. So credit policy is integral to making sales. Timeliness. So bad debt loss matches the revenue that is generated. And neutrality and faithful representation. So you should not be overstating the amount that's actually going to be collected. Allowance for doubtful accounts, which your textbook calls as ADA. I'm used to calling it AFDA, so both of those things made allowance for doubtful accounts. So allowance for doubtful accounts is a contra account relating to accounts receivable. The balance in the allowance for doubtful account is management's estimate of what will not be collected from customers that is included in accounts receivable. So the gross accounts receivable amount minus the allowance for doubtful accounts amount equals net accounts receivable. The net amount is what actually shows up on the balance sheet, but the amount of AFDA would have to be disclosed in the notes to the financial statement somewhere. The contra account tracks the amount allowed for bad debt expense. So it allows the subledger and the general ledger to agree, and it reflects doubtful versus specific uncollectible accounts. So Exhibit 5-6 on page 215 reflects a journal entry that would be recorded to set up an allowance for doubtful accounts. So you would debit bad debt expense and you would credit allowance for doubtful accounts. So previously we discussed the direct write-off method, which is where the company knows that a specific customer won't be paying their accounts receivable amount. So they write that off and accrue an allowance for it. Other than the direct method, there's two other methods that can be used when you set up an allowance for doubtful accounts. The first is the percentage of sales method, and it's also referred to as the income statement approach. So this is when you match the bad debt to sales. So you use a percentage of credit sales to be the bad debt expense. So the emphasis is on the income statement versus the balance sheet. So for the procedure for this involves, number one, estimating a percentage factor and applying that to net credit sales. Number two, adjust previous amount to agree with the new estimate. And number three, the other side of the entry, usually a credit, adds to allowance for doubtful account. So for example, if you have total sales during the year of $250,000, that's your credit sales balance, because sales is a natural credit balance. And the company estimates that 5% of credit sales is uncollectible. Then that would mean that $12,500 is considered to be uncollectible amounts, because that's 5% times the $250,000. So the balance of bad debt expense, in this case, they're saying should be $12,500. So if it already has a balance of $2,000, then the adjustment to post would only be $10,500, because you're just trying to get it to that $12,500 balance. So in this example, the estimate is based entirely upon how much is on the income statement, so how much is in sales. So that's why it's considered the income statement approach. The second method is the aging of accounts method, which is also known as the balance sheet approach. So this is where aging of accounts focuses on the net accounts receivable on the balance sheet. So the aging of accounts receivable is when you categorize accounts receivable according to the length of time that has passed since the invoice date. So the next slide will show the different types of categories. The balance sheet approach is an approach to accounting and standard setting that emphasizes the values on the balance sheet rather than the balances on the income statement. So for this method, the steps are, number one, to categorize individual receivables based on how long each invoice has been outstanding. So essentially, the accounts receivable subledger shows all of the balances that are 1 to 30 days old, 31 to 60 days old, 61 to 90 days old, etc. The aging categories does differ by company. For each aging category, you would then apply a percentage factor to estimate what amount is uncollectible. Then you would figure out what's the actual existing balance in allowance for doubtful accounts already, and then adjust allowance for doubtful accounts to get up to what your total uncollected estimate is. And the other side of the entry affects bad debt expense. So, for example, say company A estimates that for all accounts receivable invoices that have been outstanding 1 to 30 days, they think 2% of that is not collectible. Then for all AR invoices that have been outstanding for 31 to 60 days, they think 7% are not collectible, etc. You would calculate what's not collectible based on the balance that's in each of those categories multiplied by their respective percent estimated uncollectible. So Exhibit 5-7 on page 216 goes through an example of this. So you can see they have their days outstanding categories. So they think for any that are outstanding 0 to 30 days, they think 0.2% won't be collected. 31 to 60 days, they think 0.6 won't be collected. 61 to 90 days, they think 2% won't be collected. And anything over 90 days, they think 10% of that won't be collected. So they have various accounts receivable balances within each of these categories. So you would take the balance in that category and multiply it by the estimate percent that is not collectible, and that gets you to your estimated amount uncollectible. So once you do that for each aging category, it gets you to your total estimated uncollectible amount. So in this case, based on their calculation, they're saying that $2,211 will not be collectible. So right before this exhibit on page 216, it says that they already have an existing allowance for doubtful account balance of $510. Therefore, in order to get that allowance for doubtful account balance to this $2,211 that they've calculated, the entry they need is only for $1,701. So if you look at the T account, which is Exhibit 5-9 on page 217, it shows just a different visual way of seeing why the entry is not for this 2,211, but rather for only 1,701. So income statement or balance sheet, companies often use a combination of the two. The percentage of sales method is easy to apply, so maybe that's used for quarterly reporting, and then the aging of accounts method is used at year end. Both methods involve predictions, and therefore they're subject to possible revisions in the future. So when you have a change in the estimate of what's uncollectible, that's reflected prospectively, which we went through in Chapter 3, since it's a change in estimate. So derecognition of receivables, collection, write-offs, and disposals. So there are three ways that receivables can be removed from the books. Number one is part of normal collections. Number two, through write-offs when they're determined to be uncollectible, or number three, by selling the receivables. So we're going to go through these three ways in a little bit more detail. So the first one is collection. So the vast majority of the time, you're going to collect your accounts receivables without much trouble. So when you do collect that accounts receivable, the journal entry is to debit cash to increase your cash balance and credit accounts receivable for that specific customer to wipe out their accounts receivable since they've now paid you. The second is write-offs. So this is what we just touched on, where management determines that an amount is uncollectible. So if that amount was previously recorded as an allowance for doubtful account, and now you know for sure that it won't be collected, you have to clear out the actual AR amount and clear out the allowance for doubtful account that was set up for that. So the journal entry for that is to debit allowance for doubtful accounts and credit accounts receivable. If you're collecting an amount that was previously written off, you have to reestablish the account and then record the cash collection. So collecting an amount previously written off, the example they show here is if the recovery amount is 60% of the original $100 receivable, then the journal entry would be debit accounts receivable to reset up that account and credit allowance for doubtful accounts. And then you would debit cash for the $60 and credit the accounts receivable. So now we'll go through an example problem for allowance for doubtful account setup. It's problem 5-24 on page 236. Okay, so problem 5-24 on page 236 says at the end of the current year, Felicity Limited's account show the following amounts. So accounts receivable has a total balance of $789,000. Allowance for doubtful accounts prior to any adjusting or closing entries has a debit balance of $12,000. They don't know customer accounts written off as uncollectible during the year, but bad debt expense for the year prior to any adjusting entries has a debit balance of $62,000. So Felicity estimates the following percentages of accounts receivable will not be collectible. So this is where they've used the balance sheet method, which is for each aging category in accounts receivable, they estimate the percent that will not be collectible for each. The required is, what should the amount of bad debt expense for the year be? So in this case, we would need to figure out the total amount that is considered uncollectible. So if we just copy in the information from the table that they provided us for the different aging categories. So in this case, in the 0 to 30 day category, they had $345,000 worth of accounts receivable, and they estimate that 2% of that will not be collectible. So let's just make this a percent. In the 31 to 75 day category, they have 133,000 of receivables, and they think 6% of that won't be collectible. In the 76 to 120 day category, they have 175,000 of accounts receivables, and they think 12% of that won't be collectible. And in the over 120 day category, they have $136,000 worth of receivables, and they think 20% of that won't be collectible. So if you add up the total AR amounts in each of these categories, it gets you to $789,000 total accounts receivable, which we know matches to what they had told us above as being the total accounts receivable number. So now we can calculate the uncollectible amount. So you would just take the amount in that aging category and multiply it by the percent that they don't think is collectible. So if we do that for each aging category, then they believe that a total of $63,080 is uncollectible. So in this case, we know that our allowance for doubtful accounts balance required is the $63,080 that we just calculated. However, we know that allowance for doubtful accounts has a balance already in it. In this case, they've said it's $12,000 debit balance, and allowance for doubtful accounts should be a credit balance. So we need it to get to a $63,008 credit balance. So since it's currently at a $12,000 debit balance, that would mean that we need to post an adjustment to this account of $75,080, and that would be a credit to get us to this $63,080 credit balance. So when you do that journal entry, the entry is to debit bad debt expense and to credit allowance for doubtful accounts. So if we're doing that for the amount that we just calculated, we need to adjust, then we know that we're increasing both of those accounts by $75,080. So the required for this question was, what should the amount of bad debt expense for the year be? So we know how much the allowance for doubtful accounts should be, but what should the amount for bad debt be? So bad debt before adjustments, they told us was $62,000 debit balance. Then we posted an adjustment to it up here when we're trying to increase our allowance for doubtful account balance, and we debited it for the $75,080. So in the end, our bad debt expense will be at a debit balance of $137.80. So this would be the answer for 5-24. So you have to remember to take into account any balances that are still in there before you do your adjustment needed. So that was 5-24. So the next concept we'll cover is the transfer of receivables. The first method is factoring. So this is transferring to a financing company or a factor. So accounting treatment depends on whether the transfer of risk and rewards of ownership has happened. So the first type is transferring without recourse, which means that the risk and rewards are transferred. So the transaction is considered a sale of receivables, and the company would remove this asset off of their books. So for example, say that company A has $100,000 worth of receivables, and they don't know if they can actually collect these, so they transfer them to a different company who will try to collect on those receivables. So in this case, let's say they transfer those receivables to company B without recourse. So what that means is that if company B ends up not being able to collect the entire $100,000, they can't go back to company A and say, hey, we couldn't collect this amount, so you owe this to us. So from the standpoint of company A, once they transfer that $100,000 of receivables to company B without recourse, that $100,000 is no longer considered to be company A's asset because it doesn't meet the requirements, because they no longer will get the rewards from it, and they're no longer subject to the risks of it not being collected. So when you're transferring receivables without recourse, the company that's transferring the receivables is usually willing to accept less cash than what the receivables are on the books for, because they think that they won't be able to collect that AR anyways, so they're just happy to at least get some of it. So company B wouldn't be willing to pay the full $100,000 for those receivables because they're going to be bearing all the risk of them potentially not being collectible. So the difference between what company A transfers the receivable for in cash and what the actual AR transferred is considered to be interest expense. So in your book, it gives an example. I think this is Exhibit 5-13 on page 219. So in this case, they're saying, a company is transferring $100,000 worth of accounts receivable for cash of $90,000. or sorry, it's millions, but either way. So the difference between those two is recorded as interest expense. So the second type is transferring with recourse. So this is when the risk of bad debt is retained and the transaction is considered a form of borrowing with a holdback. So when transferring with recourse, this means that, using our previous example, if Company A is transferring $100,000 of receivables to Company B with recourse, then Company B doesn't collect an amount from the customer, they can go back to Company A and demand that Company A pay them for that amount, or that Company A take the receivable back. So therefore, Company A can't actually remove the AR amount from their books because it's technically still their asset. They still bear the risks associated with it not being collected. So the journal entry to record this is different than when you have no recourse, because Company A would have to record that they have a potential liability owing, since they would have to pay Company B if Company B doesn't collect from clients. So this example is shown in your textbook in Exhibit 5-14 on page 219. So in this case, the factor, which is Company B, would pay more for the receivables than in the situation without recourse, because Company A would be bearing more risk, so they would want more money for those receivables. So in this case, they are paying $95,000 for that. Or sorry, they're paying $98,000 for those receivables, but there is a holdback amount of $3 million in this case. So that holdback is because Company B wouldn't want to pay all the cash to Company A because there's potential that they won't receive all the money from the customers. So why would Company A want to factor receivables with recourse? Maybe they don't have the resources to be following up on the accounts receivable, or they think that Company B is more likely to be able to collect the receivables because they have more experience doing it or something. If the entity neither transfers nor retains substantially all the risks and rewards of ownership of the financial asset, then the entity shall determine whether it has retained control of the financial asset or not. So Exhibit 5-16 on page 220 goes through a summary of the consequences of factoring transactions with and without recourse. So without recourse, the expected cash flow is lower, whereas with recourse, it's higher. For financial reporting, without recourse, you treat it as a sale of receivables, so your cash goes up and your receivables go down. But with recourse, you treat it as a borrowing transaction, so your cash goes up and your liabilities go up. So other than factoring, the other method of transferring receivables is securitization. So securitization is the process of transforming a financial asset into a security. It may be completed using a special purpose entity, which is an entity that is created for limited purposes, and such purposes are specified in the legal documents that create that entity. So let's go through an example of factoring receivables now. It's problem 5-31 on page 238. So problem 5-31 on page 238. McBride Motors both sells and leases vehicles. Due to sales that have temporarily slowed with the economy, the company factored a significant portion of its lease receivables. The company factored with recourse receivables with a carrying amount of $15 million in exchange for $14.5 million, less a holdback of $500,000 for potential uncollectible accounts. Due to poor economic conditions, the actual uncollectible accounts amounted to $900,000. So the required is to record the entries on McBride's books relating to the $15 million of lease receivables. So this is an example of factoring accounts receivables with recourse, which is discussed on pages 219 to 221. So in this case, since there is recourse, that means that the company that they are factoring the receivables to could come back to McBride Motors and request money for any receivables that they don't collect. So therefore, McBride can't actually eliminate the receivables from their books at this time. So the first entry that we need to make is the entry on the day that McBride transfers these receivables. So in this case, it says that they are receiving $14,500 for the receivables, but that there is a $500,000 holdback, which is held back due to potential uncollectible accounts. If we follow along with the examples that are in your textbook, that would mean that they're actually getting 14 million of cash. And the other 500,000 would be considered as receivable from the factor, since that's the holdback portion. The credit in this case is not to accounts receivable because we know that we can't wipe that out yet since there is recourse. So instead, it's considered short-term debt as an asset-backed financing. And that would be for the whole 14,500,000. So the second step in this entry would be to record the entries upon the actual final collection of cash. So in this case, they stated that the factor wasn't able to collect $900,000 of the receivables, so McBride would need to account for this uncollected balance and write it off. And additionally, since the factor couldn't collect that, then McBride would owe them that money. So in this case, this is assuming that they set up this amount in allowance for doubtful accounts previously. So the amount would be removed from allowance for doubtful accounts now. And since they owe that money to the factor, they would first wipe out the due from factor receivable balance of 500,000 that they previously set up, which they had set up here in the first because they're not actually going to receive that money from the factor. And they would also need to record the additional amount that they owe to the factor. So in this case, because 900,000 were not received and only 500,000 was receivable from the factor, they would still owe the factor another $400,000. So that would be paid in cash or like AP or something. But for the purposes of this, we'll say it's cash. So the second entry to make upon the final collection of cash is to clear out the short-term debt that we set up previously, which was the asset-backed financing. So in this case, we would clear out the 14,500,000 that we had previously set up in the first journal entry. Then we would actually record the clearing out of the accounts receivables now. So we're clearing out the accounts receivables, which were $15 million. The difference between what was paid to them in cash and the actual amount that was sitting in accounts receivable would be recorded as interest expense. So in this case, it's $500,000. So that is the journal entries that would be needed for 5-31. So on page 222 of your textbook, it goes through a really good comprehensive illustration showing the initial recognition, subsequent measurement, and derecognition of accounts receivable. So where I'm not going to go through it during this recording because, again, it's not as helpful for me to just read it out to you. It's way more helpful for you to try and attempt it on your own. So I do recommend that you try and attempt this on your own because it's really helpful to understand the concepts that we've just gone over. So try doing it without looking at the solution. The solution's like literally right below it on page 223, but try covering it up working through it and then check to see if you were correct or not. So for non-trade receivables, these are things that generally have written contracts. So for example, a promissory note, which is a written contract that specifies the amount and date on which one party repays another party. So a note receivable is also an example of this. So these are usually infrequent and are outstanding for longer periods of time, and they should be recorded using present value techniques. So an example of that is shown on page 224 to 225. So this is based on the idea that a dollar today is worth more than a dollar tomorrow due to inflation. So to become more familiar with that, I'd recommend that you go through the example on page 224 to 225 on your own. And right now we'll go through a different example problem together, which is problem 5-42 on page 242. So problem 5-42 on page 242. On January 1st, 2019, Carrot Company agreed to sell a diamond to a customer at a special price of $5,000. The payment terms were $1,000 on that day, January 1st, 2019, and then $1,000 every January 1st from 2020 to 2023. Carrot normally charges 6% interest to its customers, but it didn't charge interest on this special sale. So the required is how much revenue and how much in accounts receivable should Carrot recognize on January 1st, 2019. So in this case, the time value of money is considered significant because the receivable is due over an extended period of time. So that receivable comprises of the payments that are not being made today. So today they're paying $1,000, but the other $4,000 is being paid over time at $1,000 each at annual intervals 1 year after the date of sale. So therefore, we need to calculate the present value of that $4,000 that's being received in the future. So I'll show you right now how to do the present value in Excel. And I can also show you the formula that's used on a financial calculator. So I think you guys probably all have that financial calculator that can do the present value. When we go through later chapters, I'll show you the actual longhand present value calculation formula, and you will be given that longhand present value formula with your final exam. So in this case, the terms given to us are as follows. The payments each year is $1,000. The number of periods, this is payments each year. The number of periods is 4 because that's 2020 to 2023. So 2020, 2021, 2022, and 2023. The amount received right now, which is Jan 1, 2019, does not need to be present valued because we're receiving it today. The interest rate, they say there's no interest charged on this, but they need to use an interest rate of what the normal interest rate is that they would charge, which they said in this example is 6%. So the present value formula using Excel is PV, and then you put in the rate, which is the 6%, and the number of periods, which is 4, and the amount that's payment that's expected in each of the periods. So if we do that now, and you can see when you start typing in Excel, it tells you what goes where. So the rate is 6%. the number of periods is 4, and the payment each year is 1,000. There's no future value, so we don't have to fill in that number. So in this case, the present value is $3,465.11. And it always shows as a negative, so I usually just put a negative sign there so that it shows as positive. So in this case, we know that this $3,465 is the present value of the receivable portion. So that answers the one part of the required. So this is the present value of the long-term receivable amount. However, the amount of revenue to be recorded is actually different from this, because the amount of revenue to be recorded would be this present value of the long-term receivable plus the $1,000 that we've actually already received to date. So the revenue amount to record would be a little bit higher at $4,465. So if you're trying to do the present value formula on your, I think it's like BA2 plus financial calculators, there is a formula that you can use, which you can probably also Google what the formula is. So you would enter in again the number of periods, which is 4, the interest rate, which is 6%, and the payment amount, which is $1,000 each period, and then you press the compute present value, and it gives you the same present value that we got in our Excel formula. So that is P4 or 5-42. So the next concept is accounting for restructured loans from the perspective of the lender. So this is when there's evidence that the debtor will not pay the original amount. So the loan or note needs to be marked down to reflect the present value of the new payment stream. So on page 225, it gives you some background information related to this journal entry that they're posting here. So they're saying the loan repayment of $100,000 was originally scheduled to be received on June 30th, 2018. However, the borrower had financial difficulties, so they couldn't pay that day as expected. So now they're expected to pay on June 30th, 2019, which is 1 year later. So you would have to redo the present value since it's a whole year later now, and the difference would be recorded to a loss on note restructuring. So potential earnings management using receivables. So users need to be aware of how accounts receivable can be used for earnings management. So to either manage earnings or to manipulate the amount of revenues reported. So we'll go through a few ways that this can be done. The first is through the revenue recognition policy. So a company can boost earnings by accelerating their revenue recognition policy. So users should be alert to increases in days of receivables that are out of proportion